Welcome to all my co-panelists, Saurabh, Pooja, David, and Jyoti. So I think we are up for a very interesting session. I think rescue finance is something which is very close to my heart as a person, as a restructuring advisor, which I feel is and it's a topic which we all need to deliberate in greater details. Despite we having seen 6 years or 7 years of intense work going into resolution, especially on the insolvency side, both outside IBC and inside within IBC. I think rescue financing is something which is still a puzzle, at least for me. How to navigate through this. While I personally feel that rescue financing is something which is utmost important for any company, whether it is whether it is outside IBC or whether the company has gone into IBC. Outside IBC, for sure, rescue financing is something which is required to make that company survive or to preserve the value. And we have seen in so many cases where funding in right proportion in right time is, if it is provided to a company where operations are viable, I think the value of that company is and goes up significantly high. And if it ends up getting into an insolvency situation, the value of the company goes down significantly and beyond any repair, beyond any revival. And similarly in IBC situation also, right? If you have rescue financiers providing capital and the existing lenders allow them to provide capital, the business turnaround becomes easier and the operations becomes much more simpler. But if it is not allowed or it is not given, we have seen companies' value getting deteriorated very fast. So with this, I think my first opening question to Saurabh, to you, basically, without getting into any specifics, do you think that as in India we have adequate infrastructure both legally and commercially? And commercially, when I say more from a banker's perspective, financial institutions perspective, both existing lenders as well as a lender or a financial who's coming in to provide rescue finance. Do we have sufficient infrastructure to support this mechanism or this instrument, so to say?
Good evening, everyone. I hope I'm audible and you can hear me clearly.
Yeah, you are.
Yes, Nitin. I mean, your question is very valid, and I think
so we can hear you.
Yes. So, I mean, to respond to your question, Nitin, yes, I mean, this is one of the key aspects of resolution of insolvency. And this is an area where I think there has definitely been some thought which has gone into putting together some sort of a legal framework to help assist in rescue of a firm in distress. So we have a concept of interim finance in insolvency, as we all know, in terms of which a company, once it's in insolvency and requires, say, funding to keep it as a going concern during the resolution process, there is availability. I mean, there is a mechanism to avail funding, and that funding has priority over all pre-insolvency claims. So that's the law on rescue financing during insolvency stage. Even pre-insolvency, I think both under RBI's June 7 framework and ECB framework, there are mechanisms which are in place to help a distressed firm raise financing to be able to settle with its lenders and to remain afloat. But if you see in a commercial sense, the point that you were raising, in a commercial sense, if you were to look at rescue financing in a pre-insolvency framework has several challenges. We don't really have a consolidated framework recognizing priority of a lender who is coming to do rescue financing, except, say, this fund, the Swami Fund, which has been set up by central government and which has been notified as a recognized source of interim finance, which will have priority. even in insolvency. Other than that, if you see, mostly interim finance in a distress situation has been left to be arranged by a firm in distress and through a contractual framework. So largely it is left to parties to find a source of funding and get everyone who was involved in the company pre-stress to agree on terms of it. Now, legally, to say that it's possible to raise financing, yes, it is possible. But in a situation of distress, leaving parties to negotiate and come to terms of an interim arrangement which will be marketable, which is really to give priority to someone who is coming last, but who is most critical to save and rescue a failing firm. I think that is a area which needs to be say strengthened a lot more, because on that side, I think really our laws really don't give any special treatment or protection to someone who is coming and lending pre-insolvency in a distress situation, which will be the most critical stage where you need funding. So I think that's an area where definitely there is a gap today. Even in insolvency situation, while theoretically, yes, this is an option which is possible. If you look at last 5 years or 5-6 years record in terms of how many cases really this interim finance has flown into companies to help them survive, I think the record is not that great. And that also in a way speaks for how confident the banking system is. Because it's always a case that do you want to give rescue financing with a certainty of resolution, or you should be giving rescue financing with certainty of your treatment, which will be last in, first out. Now that last in, first out, if you only offer in insolvency, effectively you are pushing companies to really look at insolvency as an option. That can't be the most ideal framework really. And in that sense, I would say that our framework really needs to plug that gap. I mean, if we can plug that gap, it can really incentivize more resolutions and not really push companies which are facing difficulties to go down for want of availability of rescue financing.
Sure, Saurabh. So, Saurabh, I think I'll put this question to you, and you can even think about it and keep it as an answer. So, you and me both have worked on a situation where we were trying to structure a sort of interim finance or a rescue finance pre-IBC, right? And we were trying to create a priority structure. So I would like to know from you, or maybe understand from you, and you can talk about it later, maybe at the end of the session. 2 or 3 points which you believe, right, which are ultimately rescue finance protective for the investor's perspective, and how do we ensure that it becomes actually practicable for any investor to come in and invest, and also for the existing lenders to sort of cede that charge of priority. It should be win-win situation. So if we can think about that, it will be great. And before that, probably I'll move on to Pooja. So Pooja, we heard Saurabh saying that while there are legislation both pre-IBC and or post-IBC. Pre-IBC, I'm sure there is. I would not say it's a legislation. It is more of a guiding principle, and it's more driven commercially than legally. While IBC provides protective rights under the law itself, but still we have not seen enough appetite both from the lenders providing capital or lenders who are existing in the company to seek such type of resources to revive the company. So what are the real means available to your mind in India? Is it only promoter capital which can be seen as rescue finance, or you see that there are options and we can work with those options?
So Nitin, I think we can see it from a different perspective, and let me break it up into, again, when the company goes into NCLT and the companies outside NCLT. I think we all even heard the previous session talk about it, that while there are regulations in place, you don't really find people giving rescue finance when the company goes into NCLT. I feel primarily because we are also in a creditor in control regime right now, where there is very little incentive really for promoters to give any kind of a rescue financing once the company goes into IBC, because there are limited ways in which the company can really revert back to the promoter, assuming that 29 he's not hit by 29A. The other thing that we've noticed, of course, when the company is in NCLT, CIRP process is that the lenders are not very inclined to give approvals for any kind of a rescue financing during the CIRP. They want to limit it to costs. So whatever is required to really fund the costs, you would typically get an approval for that, and that too from the members itself as opposed to anyone else. So, and with a lot of MSMEs, we see the financing being really in the form of, job work sort of a situation where a lot of MSMEs would hire someone to do the work on a job work basis to keep the company afloat. When we talk about pre-IBC situation, when the company is really approaching insolvency, and I think there is a bit of a shift when we talk about a time when the IBC was there and the time after the IBC came into picture. Now, before IBC came into picture, we were, of course, seeing promoter financing happening. We were also seeing existing banks giving financing. A lot of times they would insist on promoter also bringing in equity. You would also see cases where promoters would get money from, let's say, an NBFC to put in. I feel that post IBC, there has been a little bit of uncertainty around it. And going back to what Saurabh was mentioning earlier, because IBC has come into picture, this entire issue around priority has really come into focus. Because now we know that there is a very imminent risk of a company actually going into IBC if the company is distressed. So till the time you don't have clarity on issues around priority, security, you will not really have existing lenders putting in money. From a private equity investor's perspective, it is difficult because the risk of company going into insolvency is always there. They know that if they put in equity to bring in that last mile financing, that equity can get wiped off in resolution process. If they put any type of financing, again, because there is no priority status, there is a bit of an issue. So yes, I would say that in those situations also promoters are one of the primary sources, but only if they feel that they will be able to really stave off insolvency. Because if it looks like that, even after putting in the money, if it looks like there is no certainty that the company will come out of the insolvency process, then they would also be hesitant in putting money in. So there is perhaps a need to bring in more capital providers, someone who can, other than promoters, other than banks, foreign capital providers. But to bring that regime in, as Saurabh mentioned, we will need to have some sort of a legal infrastructure in place to provide them comfort that in case the company actually goes into insolvency, their capital will be protected.
So basically, what we are concluding or alluding to is that while framework is there, but framework doesn't provide enough checks and measures for people who are providing capital, at least prior to IBC, to ensure that if the company by for whatever reason, because obviously there is already an emanating stress, and there is no certainty that stress can go or the company will revive. Obviously, there is a possibility that once the investor or capital provider is providing capital, the company has better chances of survival and revive. But obviously, there is always a risk. But that risk is not getting mitigated by virtue of the existing framework, right? So maybe we'll debate on this further, Pooja, and probably you can add, what are the suggestions would you have for our lawmakers to see how these things can be addressed in some forms or maybe others, or maybe 2-3 points if you can add to it. We'll take it from there. David, you heard what Saurabh and Pooja spoke about the Indian legislation, both under IBC, prior to IBC, rescue financing. Now, rescue financing is not a new phenomena. It is prevailing across globe, right? And there are enough investors, funds, private credit, providers who are and who have this as their day-to-day business, right? And they keep on providing capital to companies who are in distress. Now, what is it you are seeing globally, which probably we can learn from, where such capital is freely or easily available? What are the things you see globally?
Yeah, thanks for that. We see that these funds, well, there's a lot of dry powder out in the market. A lot of private credit, hedge funds, private equity that are looking for deals. But generally speaking, they're looking at probably 5 factors, I think, before they decide to enter into a deal. One of which would be viable business. Need to understand what went wrong, what the business plan is, path to profitability, cash flows that were generated. The second one is the capital structure dynamics. Need to get an understanding of what the debt structure looks like. Is it bilateral loans, syndicated loans? Are there bonds? Is it institutional? Is it retail? Also, the industry dynamics are important. Is the industry is it improving or is it declining? Does company have real brand? Does it have real IP? Does it have a differentiated product where there's some synergies? I think as a fourth point that these funds are looking at is the valuation dynamics and the investment entry point. So looking at going concern value, liquidation value, the value break analysis, because that then determines where is the best place to enter. Is it buying the secondary debt in the fulcrum security to do a loan-to-own strategy? Is it more of a distressed M&A type transaction? Should I come in as a white knight? Or maybe they just wait for an insolvency sale at the end. And then the last point is downside protection. They're looking at having some assets that are there to protect in case it goes bad. And maybe I'll share with you some of the cases that we've been worked on in the last 6 months or so. We were involved in a company called Pacific International Lines, which is a top 10 global container shipping company. We were involved as a scheme manager. It was $3 billion worth of debt involving a scheme, and it was 600 million rescue financing from Temasek. Came in through a fund called Heliconia. And shipping is a difficult sector, but obviously there are certain benefits to shipping as well. It's very cyclical, and they've come in it now, which is probably a very opportune time. The demand and supply dynamics are very favorable for shipping, so they've timed their investment very well. There is downside protection in the form of vessels, and the balance sheet has now been restructured and with the recapitalization, the leverage is a lot lower. So there's a chance for them now to have some opportunities to create some equity value. And we did a similar deal for another Singapore listed company called Viking, which is oil and gas. We were the lead financial advisor. And then it was a scheme involving a haircut with banks, haircut with other creditors, and new equity came in. And they have now got basically a debt-free balance sheet and a position in that business for growth. And straight away upon the resumption of trading, the equity was already up 50 times. And now it's traded down a little bit, but it's now up 17 times based on the last traded share price. So white knight opportunities, I think, are interesting, and it's all about picking the right entry point and the right valuation to come in on.
Sure. No, I think these are all valid points, David. Most of the investors in India, while investing or providing rescue finance, also see such, parameters, right? The challenge is more from a structure perspective. So on that, probably, Jyoti, I'll request you to maybe answer this question. If you can throw some light, how international best practices or legal framework, support such type of funding, maybe in other jurisdictions as compared to India. So if you can just give a comparative, analysis on Indian, we have already heard from Pooja and Saurabh. Maybe if you can just throw some light from international perspective, and then probably we can, learn from those best practices.
Sure. Thank you, Nitin, and hi everyone. So I'll be covering few jurisdictions, right? I mean, we all know that US is the very first jurisdiction where debtor in possession finance, it's called DIP financing, started. The code itself came in 1978. And there, I think each efforts are made in order to ensure that there is a rescue finance available. And the reason is that it's debtor in possession, which is very different from India, where it's creditor in control situation when it goes to IBC. And as Pooja rightly pointed out, that even little prior to going into distress, the promoters are not very sure whether they should bring in money or there should be other creditors who want to come in, because the existing creditors whose entire funding itself is going for a toss, they may not want to cede the charge even to the new lender. Then Singapore, came in 2017, and there are in fact case laws developing over there, where they call it as a super priority loan. But in one of the first matters in Singapore High Court, which was Achillean Group Limited, there the entire framework of what the court needs to look into while granting and super priority funding, while the existing lenders have to take a back seat, ultimately are very critical to see as to whether there is such a need that somebody else should bring in the money over the existing lenders and should be given a super priority. Okay, and ultimately that was rejected, but there is a case law developing in Singapore. But again, we see that in US as well as in Singapore, it's a court-driven process. You have to file an application to the court. While in India, pre-IBC, the only application that can be filed is scheme of arrangement, and that too also, of course, with consent of a certain majority of the lenders, and which because of the reasons that Pooja, Saurabh, and covered, are in that sense difficult. They don't agree to that. Australia again is a very new, in the sense, very recently, in fact, on 23rd September 2020, last year itself, the government announced that they, from 1st Jan 2021, they will introduce a new rescue process specifically for SMEs. But there again, it's a court-driven process. You need to really obtain a court order under the law over there. And I feel that when there is a court involved, there's some sense sometimes can be brought into the financial creditors also, because sometimes that last mile funding can make your funding, can save your funding from going bad. And I think that sense sometimes comes in when it's a court-driven process. Brazil again is very new, where January 2021, there is a new section that has been added where the companies are regulated who are under a court supervision reorganization. There again, there is a concept of COC. So in some of the situations, the court really, if it's like for the day-to-day need, then the court intervenes and passes an order. But if it's a long-term funding, then a COC consent is needed. So again, there is a difference as to why do you need this funding, and accordingly the court intervenes. UK, I think, and David and others can add, but according to me, has not really done much, in this space, because, UK is criticized because it's more creditor friendly, in the sense it takes care of the interest of the creditors more than really ensuring that, the ailing companies get finance so that they can be reorganized. So this is a little bit, so, the only difference I would say is that in all these jurisdictions from where, in a way, we have taken some sort of a cue in IBC, and we introduce provisions where it is clarified that if during the CIRP a company is, in that sense, needing an interim finance, and the COC agrees to do that, then in liquidation, that interim finance will get an interest of 12 months or something. But unfortunately, what happens is that since it's not court-driven, COC is the driver, and they may refuse or agree on interim finance even when it's needed. And it may be challenging for RPs here, because sometimes in order to keep the enterprise value of the corporate debtor going, I think lack of interim finance, sometimes becomes challenging. So yes, there is no framework prior to IBC scenario as such. There are no restrictions also, but the market needs to develop, because as Pooja rightly pointed out, the promoters are not going to put their further money into something that's going bad. Thank you so much.
Maybe if I could just comment quickly. In Singapore, we have super priority, and there's been, since the Atalan case, there's actually been 5 cases, and we've been involved in actually the first 3 of those cases, and it's developing. And now there's some level of sophistication around taking security over unencumbered assets, priority over winding up assets, and also we've recently had a roll-up case where old debt was rolled up into super priority. We haven't yet seen a priming case where we've secured over existing security, but that's probably the last one that I think will be challenged, or the last one that will be taken up, because it's obviously got a lot of risk and challenge for our creditors.
So basically, what I gather from both of your comments is basically that internationally, priority funding is an accepted phenomena legally, because the resolution process is a court-driven process rather than outside the court, which we see in India. So India has 2 sort of resolution framework. One is prior to IBC and then post IBC. And obviously, prior to IBC, doesn't have any legal, framework around it. While commercially you can agree on certain terms, but since there is no legal foundation or legal, support, people or the financials or lenders find it difficult to provide, funding. But I think it's more of a commercial, thing also, which needs to evolve. As I see it, legal is one thing, but if you can commercially agree upon, I think a lot of these issues can be resolved. And hopefully, as we are moving towards the pre-packs, this situation may get answered to some extent. Now, while where we are sort of with these legal framework or legal issues around rescue financing. Still, we need money. Still, businesses need money to revive and to survive. What, in your mind, could be, possible structures, frameworks, or protection, or should be considered to ensure that there is enough and adequate flow of funding to distress businesses?
See, currently, Nitin, as I think all of us on this panel are agreeing, there is a limitation when it comes to a pre-insolvency framework and access of, say, credit to a distressed company. What we are seeing mostly in last 2-3 years in the Indian context, at least, is that wherever you are looking at a rescue in pre-insolvency also, it's largely change of control transactions. And if it's a change of control, with that, there is availability of credit from formal banking system also in India, and overseas lenders are also under ECB route allowed to fund, and you have AIFs, FPIs, all can fund. So that is one route which is quite, operational, and we have seen transactions also happen through that route. Now, the point which both Jyoti and Pooja mentioned, that I mean, in a Indian context, we also have a situation where 29A is there, which would imply that from a promoter perspective, his skin in the game is reducing by the time stress is developing. So you really can't practically, realistically expect promoter to put in more money. In that situation, what we see as...
Sorry, Saurabh. 29A is only applicable if the account becomes NPA. If it is not an NPA, it is only a distress situation where, promoter still feels money can be provided.
Absolutely, you are right. But you see, I mean, from say in terms of ability to resolve, I mean, the confidence that banking system has today in distress accounts, really with a 29A construct, the sentiment really has been that in a distress or a failing firm, there is a misconduct which is there. And with that sort of an assessment, to have a very, say, commercial assessment of a distress situation, and for bankers to be able to take a call, I think that's where this whole 29A has had a cascading effect really in say, affecting the ability of banks or credit providers to take a call. And I see that, I mean, in the current environment, at least, I mean, 29A is not going away anywhere. In the current situation, without a change of control, if you are really looking at, say, saving a firm, which may have external reasons for stress, it could be competition, a COVID kind of a situation, sector doing badly. In those situations, I think clearly there is a need that if you have a, say, June 7 kind of a framework, which is triggered on default. Now, say, once an account is 60-day outstanding, can you not, say, allow funding to flow into those companies, giving them similar protection like what you would give to someone who is lending in IBC? Why would you want to wait till a company reaches insolvency to facilitate that funding? I think that's a point which can possibly be considered. Otherwise, you will largely have a situation where you are forcing change of control because of the framework, or you will have, say, ARCs looking to buy out debt, but it may not always give the most efficient outcome, because ultimately there may be some sort of a asset sale or a change of control which ends up happening. And our experience, at least you see now, courts are also commenting more and more on the value that you are realizing as existing creditor in resolution. So if you see from a creditor perspective also, a 29A is having some effect on ability to raise financing. So to create some sort of a level playing field, I think if that protection at least comes, that irrespective of source, if you have given rescue financing and with consent, like you have prepacked decision-making threshold, with that decision-making threshold, if you allow financing to be raised, then, and there is protection for that, I think that can help solve situations where it is a cash flow problem, really. And it's not it's a complete insolvency. At least some sectors we have seen going down also because of these problems. So I think that could be one way to address, but without without there being some sort of a regulatory legislative solution to this, with a 29A, I think it will be more a case of change of control or a insolvency linked in interim finance, which will be the most likely situations. A pure contract driven 15 lender, 20 lenders agreeing to let someone come in and have priority, I think the confidence level goes down so much by the time the stage reaches. I think it will be quite difficult to expect that lenders will be able to take a very commercial call and facilitate resolution and let seeding their priority.
Sure. No, absolutely. I think it's a very comprehensive comment. So no, we spoke about 29A. We spoke about priority. So these are all challenges which come in way of capital providers, right? Pooja, from the existing lenders' perspective, right? What do you think that they are afraid of, or what makes them not consider such situations? And some of these problems can also be resolved, by way of, if not complete priority, but giving an exclusive charge on a particular security, not the entire set of assets as mortgage. What do you think that makes them nervous about getting a finance when they know that if money comes in, business has a better chance to revive?
Nitin, I think one of the biggest issues is, historically speaking, our lending has been extremely complex when we think of security structures. We have, working capital, term lending, we have pari passu charges on current assets, receivables. We have a very complex security structure. And that, I think, makes a lot of banks very hesitant on ceding charges, because nobody really knows what's going to happen once the company actually goes into insolvency. So therefore, even I feel like till today, despite 5 years, we thought we've got some certainty around how charges are going to be treated in a resolution or in a liquidation scenario. But I think we're back to square one with Amit Metallics and some of these other judgments, where currently, even with security being there, lenders really don't know where they stand in a resolution or a liquidation scenario. So that, I think, is a one big challenge where nobody wants to cede the charge. And it takes a very, very long time to get your own internal approvals to get all of those ceding of charges. We have very large consortium financing, traditionally speaking. We have multiple lenders. We have different type of lenders, sometimes in the same account. We have banks, we have NBFCs, we have NCD holders. Aligning all of them together, coming to some sort of a consensus, that is quite challenging. Coming to any sort of a documentation around it is very challenging. And then you have to remember that we are a very PSU bank-driven lending still. And there is a lot of fear that most of the bankers would have in taking any sort of calls around, especially ceding of security. So I think that is one big worry. June 7 circular, of course, talks about additional financing and that not being downgraded to NPA. So at least from that perspective, there is some regulatory comfort which is there, but that is only if the account is doing satisfactorily during the monitoring period. So that again, I think, is a bit of a disincentive when you talk about downgrading of the standard asset to the NPA. So one, of course, security structure being extremely unclear. That's why they're hesitant. Second is the entire NPA issue, and the third is also, I think, for a lot of PSU bankers to give financing, they also need to have a lot of clearances from a forensic perspective. They need to be clear that if there is no change in control, then the promoter actually is in the clean. And getting all of those evaluations done, I feel also sometimes is cumbersome and takes time. So I think these are broadly 2 or 3 things which perhaps makes them a little hesitant in giving interim finance.
So maybe some changes to maybe June 7 circular. I know June 7 circular cannot extend its jurisdiction to cover IBC law, but some sort of framework. While there was earlier a framework in the form of a JLF or JLM, today we don't even have that. We need a 90% approval if we don't have a ICA sign. So I think that's a bit of a challenge. So no, I appreciate your points, Pooja. Jyoti, coming to you, we have debated most of the challenges both from the financial side and the lender side. But having said that, we have to live with these challenges. What are the situations you think can lead to a rescue finance success, both from maybe a finance provider's perspective and from a lender's perspective? How do we sort of bring them or mitigate all these challenges and make things amenable?
So see, currently, I think in India, we are just clearing up the historic cases where the liquidation value is nearly nil, 10%, 5%, 10%. But I guess the only way to, in that sense, strengthen interim finance will be vigilance, by early detection of any sort of a stress. What we need to really, in that sense, understand is that rescue from going to IBC, not rescue from going to liquidation. So I think once we have that clarity, and obviously market needs to really develop, and I completely agree with what Pooja said. Keeping all this in mind, the only thing that comes to my mind is, of course, lenders being much more vigilant when the going is good. And I've been saying it, before IBC, during IBC, that what happens is that if everything is going good, then nobody really, in that sense, take any steps. So if there is any, and if there are early detections of any sort of a stress, then the interim finance or a rescue funding can be done by the existing lenders itself, because they're already invested in the business. Okay, and you don't need any third lender to really come and take over at a higher rate of interest. They may also do rescue finance, maybe not at a very high rate also, as long as they know that the business turnaround can happen. So, for me, I think it's only dealing with the problem early, and really, in that sense, ticking those boxes to say whether the business is doing good, what can be done further. So not only invested in lending, but also being invested slightly in the business to see that you are not really looking at the promoter, but you're looking at the business. That's what comes to my mind.
Sure. So David, one last question to you, now from an investor community side, what are the top risk reward matrices does an investor look at, for providing rescue financing? Commercial, you spoke about in terms of cash flows, in terms of revival, but what are the risk reward matrices which one should be cognizant of?
Yeah, I think a lot of the investors are looking at downside protection as their main form of security or risk mitigation in new investments in distressed situations. And the ones that we've seen, I think, if you look at, say, for example, the super priority deals that we've done in Singapore here, those investors have come in and have got the court's backing to get the super priority, either in the form of priority over preferential creditors or priority over unencumbered assets. And I think that gives them some downside protection in case it doesn't work out. In terms of rewards, obviously they're looking at entering at good valuations. They're looking at things that are loan plus warrant type structures, or even just straight equity, because that is where there is potentially opportunity to make some big returns for the capital invested. Where we are also seeing some interest is outside of court, more direct lending situations where the banks have, for whatever reasons, are not able or not positioned to lend any more funds. And then there's now been a gap and companies have liquidity issues and are approaching the alternative capital market to fill that gap. And they're very bespoke type structures, again, with security, with covenants, with sometimes even cash flow limitations, as well as warrants and other equity type options that can then provide them good returns should the companies come back. So their capital is not cheap, but it serves the purpose, and I think that is what these companies are seeking, just to get them over these difficult periods. And then once they're more established, stabilized, and they can go back to the bank markets and refinance them out.
Absolutely, I think these are very, very valid points, David. But I think from an Indian perspective, I think the enforcement of the security, right, to protect, which is provided to protect the downside, is something which becomes a challenge, unless it is something outside the corporate debtors balance sheet or legal framework. So I think that is one challenge which will hit again across all the challenges which we spoke about from a rescue finance perspective. Now, I think I'm cognizant of the time also, but I think we have covered a lot of key issues around the rescue financing topic. If I have to just come around the table and ask each one of you, while we all speak about the private credit market, the rescue finance, which in a way is private credit only, right? While there are financiers which are available, there are assets which are available for taking those finance, and there are lenders who are willing to while they are willing, obviously commercially they are unable to take decisions. That's a different thing altogether. But we have all the ingredients in terms of the the transaction happening. But what are the key factors you think can help to make it more vibrant, more active, and so that we can see more transactions happening across this space? Saurabh, starting from you, maybe.
Well, I mean, there could be multiple things. I think one, protection, of course, as I was mentioning earlier, for that finance which comes to rescue the firm, getting protection, the principle of last in, first out being recognized. I think that's very important. We've also seen a lot of these stress situations facing, say, investigations from government departments. And while in insolvency, there is protection against attachment of assets, but pre-insolvency, that sort of a protection is not there. I think, say, extending that sort of a protection in pre-insolvency context also with necessary protections around ensuring, I mean, if there is a change of control backed financing, that could be another thing. From a insolvency perspective, I think from lender side, I think a time-bound process, while we say that 270 days, 330 days, but we are seeing processes taking very, very long time. So from existing lenders perspective, a certainty that while you are ceding charge, there is a very clear path and the timeline for the process to complete. I think that can also give confidence both to existing lenders as well as the incoming person to say more confidently participate in such a situation. I think these 2-3 key changes, I think if that can come in, I think that can incentivize. And of course, I mean, say commercial assessment is of course the key driver in any such decision, and ability to recover rather than having to enforce or look at insolvency. I think that's another key aspect in any such assessment to help rescue financing to develop further.
Sure. So something on the lines of what a notification from government on SWAMI fund is there.
Yes, absolutely.
Right?
Yes.
So Pooja, from your perspective, two key pointers before we conclude.
Well, actually, I'll just give one because most of it is covered. I will just say legal certainty. According to me, what we really lack in India is a legal certainty on outcomes. What is going to happen in case someone gives a security? What is going to happen if someone gives an unsecured financing? How will it be treated in insolvency? So legal certainty is important. And I know we already have enough laws. Perhaps you don't need to add more to it, but this is something which is perhaps required, is to just have some sort of certainty as to what will actually happen in case someone gives us rescue finance.
Sure. Jyoti, from your side?
So I think I'll just take you from Pooja. So I think there are enough laws for sure, but I think legislating it, bringing in some sort of a regulations or circulars where there is more clarity, and I agree with what Pooja said, that legal certainty is needed. So that's it from me also.
Sure.
Thank you.
David, investor's perspective, last bit.
I think you need to have the legal infrastructure in place. And then you also need to have banks and existing lenders that are willing to either sell or take haircuts to facilitate a deal.
Sure. So I think we all are or have a consensus house in terms of legal certainty, in terms of priority, in terms of security structures, in terms of lenders being more amenable to accept such situations. And I think more so is legislative certainty in terms of if somebody is providing some sort of rescue financing or priority debt. I think that should have that character even continuing, even if the company goes into NCLT or IBC. So I think thank you very much all my co-panelists for a comprehensive discussion. Thank you all.